Good afternoon, everybody. Welcome back to my channel. Hopefully you guys can see me. We about to dive in. Uh, I'm so excited. Okay. All right. This video is titled "How to Create or How to Build a $1 million dividend stock portfolio from scratch." And listen, I am on my way to getting there. Hopefully, you guys, if you are on the way, hopefully you guys make sure you like and subscribe and follow my journey and be a patron. And as I grow my channel, we can learn from each other. And if you are far along, hopefully we can learn from each other, and I can learn from techniques and whatnot. And if you are a new investor, hopefully you can learn this your niche and how you can create passive income and wealth. Here we go. We're about to dive in. We have this Molly Fool article. Not going to go into detail. I just wanted to focus on certain key points because the key points is what's really going to hit home into helping your journey to help you stay consistent. One key point: how you make money in the stock market through long term investing consists of consistency is key. Regular investments, whether it's $250 per month, as you hear in this investing community, dollar cost averaging, time in the market beats time in the market. Picking out of the beginning of the month or the end of the month, whether it's $200, $250, $500. For me, I drop $1,000 per month, whatever your budget can. But it's invested into your snowball, your portfolio. Invest into stocks that you like, that's personal for you, that's going to help bring you wealth, right? It's Apple, Microsoft, JP Morgan Chase. Let's say, hey, I invest to Apple because guess what? If I have an Apple iPhone and I'm buying $200 for a phone, I want to own Apple stock. If I use Microsoft, I want to own Microsoft. I use Chase, my Chase debit card, I want to use Chase. And so how I really invest is that if I spend money on it and if I use it and I know about it and I'm confident about it, why not invest? If I have a house, because I have a house, and I go to Home Depot a lot, why not own stock in that? Get paid in that. So it makes sense. And that's why consistency is key. Starting early, everybody, they always say the best time to invest was yesterday. The next best time is now. So if you are in your 20s, 20, 25, 30, great. If you are 35, 40, just starting out, hey, you still got time. You probably just have to invest a little bit more, but you still have time. Here we go. And so this shows. Just wanted to show real quick. This shows the time periods. If starting out with $1,000, starting out with 5,000, starting out with $10,000. So it says right here. Let's keep in mind if you are investing $1,000 and left it alone, $5,000 left alone, $10,000 left alone, and just you had your money compounded at an 8% rate of return, how your money will grow. So with $1,000 in 40 years, your 1,000 will grow to 21,725 if you don't touch it. The 5,000 will be 108,000. You won't touch it, and then 10,000 will be $217,000 if you have not touched it. Now it says now that none of these amounts even come close to $1 million. But remember that one of the keys to building a $1 million portfolio is to invest consistently. Invest consistently. So what if you invested $1,000 again, same 5,000, or even $10,000 every year? All right. So let's start here. You have three examples. You start with $1,000. You invest $1,000 per year. What happens? $5,000, and you invest $5,000 per year. And then right here, you have $10,000, and you invest $10,000 per year. After 30 years, you have $123,000 right here, $616,000 right here, $1 million right here, $1.2 million. You extend it out to 40 years, 280,000, 1.4 million, 2.8 million. So what you learn right here is that really it's the investing consistently along the way that helps. A lot of times, a lot of people may not have the whole $10,000 to invest per year when you're younger, but you will have it probably when you're 35, when you're 40, 45, 50. But if you invest in regularly, if you invest in at least $5,000 per year, you're at least getting the money in the market to grow and to compound. And then right here at the bottom here, it's just acts like, uh, are you still on top of your credit card debt? Do you have an emergency fund? Yada yada yada. Right. Uh, individual stocks versus ETFs like VOO, index funds. Here you go. We're gonna go. Now we're gonna go into more detail. Now I created a simple portfolio for you guys to probably look into. You don't have to remember. This video is not encouraging you to go out and buy these stocks and for you to make go out and lose money. Whatnot. Remember, this video is only for educational purposes only for you guys to learn and for you to see that it's possible. Like again, you choose whatever stocks that you want. You invest not just one time, but you invest consistently, and then you see how the money grow. I chose 10 stocks for you guys to look at. We have Apple that's at $212. We have Microsoft that's at $452.68. We have Home Depot. We have Chevron, J.P. Morgan Chase, Johnson & Johnson. We have Aflac, ExxonMobil, and we have Broadcom. Let's say that going forward, you start with $10,000. So amongst those 10 stocks, so we have my handy dandy calculator. Amongst those 10 stocks, you're starting out with $10,000. Let's say, for example, you're starting out with 5,000. You split that 5,000 amongst 10. You're gonna put $500 into Apple, Microsoft, Home Depot, Chevron, J.P. Morgan Chase, Johnson & Johnson, Aflac, ExxonMobil, Broadcom. If you have $5,000. But in this example, we're starting out with $10,000. You've been hustling hard. You've been working on your job. You've been getting overtime. You've been doing DoorDash. You've been making your side hustle. You've been stacking your cash, right? You've been stacking your cash. You got $10,000, right? And then you take that $10,000. So you're gonna put $1,000 into each of the 10 stocks. You're gonna receive more shares more than others. So Apple, since it's at 215, you're gonna receive roughly maybe four and a half shares. Since Microsoft is at $450, you probably receive probably like 2 shares. So on, so on, so on, so on. You will receive more shares of Aflac, and then a little sprinkle Chevron, ExxonMobil, Home Depot, here and there, right? Now, with this example, it shows this is a dividend growth calculator, and it shows the parameters that you have this portfolio of 10 stocks. That's all you really need. If you want more, cool. You're just starting out, right? You do quarterly. You're starting out with $10,000. You was able to amass $10,000. Let's say that you are able to invest $10,000 per year. That's it. You've been investing. You've been investing. So you got money coming out your 401k. Cool. Your company say they invest until a match of 4%, 5%, right? Cool. And then you are investing in yourself $10,000 per year, and that's all you can do, right? Everything else has to go to your family bills, household bills. Cool. We're going to start out with the parameters of with all these 10 stocks because Apple, Microsoft, and Broadcom is going to bring down the yield a lot lower. But then Chevron, J.P. Morgan Chase, and ExxonMobil and J&J, since their yield is 2.5, 3%, 5%, it's going to bring the yield up. And so you average it out 2.5%. We're going to do a dividend increase about 10%. We're going to do a share price appreciation 10%. And let's say you started around year 25 or you start around year 30, 35. You're going to be investing in this portfolio for 30 years. So you're going to be investing in your 401k, but you're also going to be investing in this portfolio for 30 years. Let's see how much money you make, and let's see how long it would take for you to hit $1 million. Now, if you waited the whole 30 years, your portfolio have a total return of 801%. yield on cost 20.8%, and you will have a ending balance of $2.7 million if you waited out the whole 30 years. But you don't. But that's 2.7 million. We just wanted so right here. It grows slowly. Once you finally hit 100,000, then really your compound interest really start to kick in, because then your rate of return is going to be more, and then boom. If you stay consistent by year 23, you're a millionaire. So theoretically, if you started out at 30, you'll be a millionaire by 53. If you started in your 20s, you'll be a millionaire way before. You'll be a millionaire probably about like 45 if you start in your 20s. And even if you used to start late, if you used to start at 35 now, you'll be able to you'll be a millionaire by like what 55, 57, 58, 9. I mean, it's still it will still be under 60, meaning that you have a portfolio. It will only take you 23 years, and it will take you have a portfolio of at least $1 million. And the crazy thing about it is that this portfolio will be paying you $26,000 per year, which you say it's not a lot of money, but what you do is that in your mind is that you will have a portfolio of $1 million. Apple, Microsoft, and Broadcom is going to grow the portfolio because of the total return. So what you do is that when it's time for you to retire, since you have this $1 million portfolio, you sell some of the Apple shares, you sell some of the Microsoft shares, and you sell some of the Broadcom shares, and you put that money into higher yielding stocks. You're not going to sell all your Apple. You're not going to sell all your Microsoft. You're not going to sell all your Broadcom. You're just going to just shave it. You're just going to just take some off the top, the profit. You're going to take, not some. You're going to take a lot of profit off the top, and you're going to reinvest that money into higher yielding stocks. Maybe Mo, maybe JetQ, maybe Realty Income. You get what I'm saying. And by you investing into those higher yielding entities, your yield of 2.5% is going to go up to probably like a 5% portfolio, which means that in essence, instead of 2.5, in essence, you probably have a 167 245 times 0.05. Yeah. In essence, you instead of your portfolio paying you out $26,000, you have a portfolio paying you out $53,000. $53,000, and it still be a $1 million portfolio. And also, your portfolio will also be growing. Your portfolio will continue to grow because Apple and Microsoft and Broadcom will still be growing into the future, and then your other middle stocks will be growing. The Home Depots, the Aflacs, and the Johnson & Johnsons, and then Chevrons and Exxon Mobil's is only going to grow like maybe 3%, 4%. The dividend income is going to grow from those stocks, and that's how you do it. Those high yielders is going to grow fast and going to grow your portfolio. Your yield is going to be on the low side. You just sell a lot of the low yielders, put into high yielding stocks. Don't sell the whole thing because you still want total return. You still want your portfolio to grow, just in case you want to sell some for the future. And that's how your dividend income goes from you getting paid $26,000 per year to $55,000 per year. And guess what? You can live off the $55,000 per year and not have to touch your portfolio. See, the opposite is the 4% rule, where you build a $1 million portfolio, but you're selling the shares. When you selling the shares, you're selling not only the eggs of the golden goose, but you chopping up the golden goose. But here, you got your dividend growth portfolio. The $1 million portfolio is the golden goose, and the $26,000 dividend income, the $53,000, $55,000 in dividend income It's the golden eggs that you're going to continue to get year after year after year, and it's going to grow, and it's going to compound, and it's going to grow. And guess what? Now you don't have to kill the golden goose to eat it for Thanksgiving. You can just live off the golden eggs and just sell the golden eggs, and then you get some cinnamon buns and some bacon and whatever you want, and then your golden goose be still chilling and smiling because hey, it's the prize. So all in all, this is how you build a dividend growth portfolio. You implement the techniques that I went through earlier, being being consistent, investing regularly, pick stocks that you like that means the most to you. Pick about 10, staying consistent, invest regularly, and then invest more over time. And then boom, I showed you right here. And that's how you hit $1 million portfolio. And that's at year 23. It's not 30 years and everything. You start out with $10,000, you invest, $1,000 per year, boom, you hit $1 million. The issue is a lot of problem is that a lot of people don't stay consistent because you understand the first 2 or 3 years, there's no big impacts. There's no, you don't see the portfolio grow a lot. You don't see a portfolio grow a lot off 10 and 20,000, but you do begin to see more action when it's at 40,000, 55,000, 100K. You just gotta stay consistent to get there. So, lastly, just want to show you real quick. I'm not there yet, but I will get there. I'm at 59,000, as you see. I'm not there yet, but I am close to 100K. And once I hit 100K, portfolio is going to explode, and we're going to get to 300K, and then we'll get to 500K, and then we're not going to stop. We're going to keep putting gasoline on the fire to get it to 1 million. So, if you make sure you like and subscribe to my channel, make sure you hopefully you enjoy my videos. When I do videos, I like to produce content that actually is meaningful, that so you guys can see that it actually works. Not all these numbers, because I like numbers and statistics, but it's also good to see that like a person's actually doing it, actually walking what they talk. A lot of people, phonies and fakes or scammers and say, "Oh, do this and that," and you look and you see like, but you're not making money. I'm doing exactly what I'm saying I'm doing. So hopefully you guys like, subscribe. Make sure you in the comment section write what you need to comment. Follow your boy. Share my content. Show me some love. And enjoy your weekend. I'm out.